Welcome. Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office. And for my members who get live access, interaction, and other special benefits of SFO continuity, welcome. It's a pleasure to be on today. I haven't done outside of for my members as much lives lately in the last couple of weeks. So there's a variety of reasons for that. One, I'm really busy doing a lot of writing, doing a lot of in-person programming, and doing more and more that is really completely dedicated effectively to my members. I have a really special opportunity today. I know I've said that a million times. I have great guests, so I always mean it. But today I think is a little extra different. So we're having decoding risk, reward, and the future, venture capital, AI, and poker with a World Series champion poker player. That would be Rafe Furst. So joining us for this electrifying conversation is Rafe Furst. I love that name, by the way. What a great name. A man who has mastered the art of decision-making under uncertainty. And that's going to play a lot into our discussion today on investing, managing risk in family offices. So from the poker table to the boardroom, Rafe has applied his extensive experience in game theory, AI, and venture capital to really create transformative outcomes. As a World Series of Poker champion, serial entrepreneur, and retired so-called wink wink venture capitalist, Rafe's journey is as diverse as impactful. We're very excited. We have so much to uncover, including insider secrets of VC. And many of you know, although I love going to Silicon Valley, I love deep tech, I love AI, I've been very, very critical. And I get some nasty emails from a lot of GPs in general, but probably VC has probably gotten most of my wrath, although I think there are some small percentage that may be pretty awesome. So we really have a lot to cover about all these subjects and more. I think that you're going to find this will be one of the most dynamic and, of course, you know me, long form discussions that I've had. There's a lighting issue in my quote unquote podcasting studio. I like to have some level of show prep and notes. Unfortunately, I had to make a little tweak where I'm going to be looking down and tweaking and moving my head a little bit more than normal, but I'm not the star here. It's our special guest. On that long-winded note, Rafe, welcome to the show.
Angelo, it's a real pleasure. I'm very excited for whatever comes, and we don't need a script or anything because I know we have incredible overlap in our common interests and often the way we think. So,
indeed. And I would say if you're thinking of entrepreneurship, we're going to cover it. VC, we're going to cover it. Decision-making, crypto, AI, some things relative to employment, some things relative to the industry and finance. There's like 7 core subjects, and I am going to bounce around to all of them. So don't worry. If one is not your cup of tea, we're probably moving on to the next question before we come back to that sooner rather than later. I can't help but ask, I've had multiple chess masters on the show before, and chess is a wonderful, wonderful game. It does help in critical thinking and concentration and discipline, but like many things, it has a lot of rules and structure, and everything is in front of our eyes. You know what I am doing and have. I know what you have in a position that you're in. Poker involves, you could argue, an element of more luck, but that's reality of life. But also, I don't really know per se what you have. There's more dynamics that come into play. I sometimes think we overrate a little bit chess and poker relative to being a great investor, but I think there may be some small parallels. So I'm going to start. When was the first time you actually played poker?
Yeah, good question. I must have been 12 or 13 years old. I'd seen it played. I was a gin rummy player with my grandparents starting at age 5, but I didn't really get into poker until a teenager. And I just, I played with my friends. I even played in a game that had some of my teachers in it in high school. And that's really where I got my start.
And it didn't just pop in your head. You had to have either some interest coupled with you learned somehow online, through a book, through a friend, through a family member. Who was that earlier mentor, even if it was something static like a book?
Yeah. Well, there was no online back then because.
Oh, come on, Rafe. You're not that old.
Yeah,
I'm your elder, young man.
We'll see about that. Yeah. um, so I would say maybe two people. One is one of my high school teachers, the baseball coach as well of my high school team. He introduced me to Texas Hold'em before anybody was playing Texas Hold'em. It was all 7-card stud and 5-card draw and wild cards. And as you know, as everybody knows now, Hold'em really became the game that professionalized poker for most people and brought it into the global consciousness as a game of incredible strategy and courage and all in moments. So I got introduced to Texas Hold'em there. And then when I went to college, I was trying to find a game and nobody there was interested in playing in my freshman dorm. In my sophomore dorm, I met a friend, Russ Garber, and he had come from the mean streets of Brooklyn, and he'd been playing high stakes poker with his buddies for years. And we built a game that continues on to this day. I still play with the 12 or 15 friends that in that game. And so really it was that college experience that got me on my way.
And how would you recommend to someone to get better fast?
These days, you can go online, you can sign up for free poker online, and you have incredible resources at your fingertips. So, I mean, there's great books, one written by a friend of mine, Phil Gordon. He wrote The Little Green Book, which is, I think, the best original primer. Phil and I produced a DVD that teaches you all about advanced concepts in No Limit Hold'em called Final Table Poker, Expert Insight, Final Table Poker. But frankly, these days, AI, you can go on a ChatGPT and just ask it any kind of questions you want about strategy, and it's like magic. So books, videos, and use AI. And of course, play. You have to be playing. Because
but you can't just play for the sake of playing. Like in any sport, I could be learning how to hit a baseball and do it 10,000 times wrong. It might even reinforce negative habits in me. So understanding how you get better, be willing to fail early and iterate and constantly get better. Otherwise, you're just beating yourself up against the wall and you're going to be discouraged and probably not play anymore. Or there's going to be one sucker at the table, and I wonder who that's going to be. It's going to be you.
Yeah. Well, you bring up a great point, and built into the game of poker is a feedback mechanism. It's called winning and losing money, and that's the best.
That's pretty good feedback.
So if you're winning, and even if you're playing for, not real money or play chips, you're still getting that feedback loop. I recommend playing for money because it's a great motivator, and there's a sweet spot. You don't want to play so high that you feel nervous about the losses, but you also don't want to play so low that it's boring, because you have to be in that zone, in that sweet spot to engage your system.
That's fantastic advice. I'm going to name 3 things that I look at when I'm maybe looking at earlier stage investments in an entrepreneur, which is almost always a losing fight, but it's fun. When I'm looking to hire, and if I was in the role of a VC, I look for a raw intelligence. I look for the ability to move fast. I think generally, and family offices are notorious for this, they're so slow. And there is a third one. It's obsession. I look for, those are my big 3. Raw intelligence. Now, I could argue the capability to act upon that in discipline. Yeah, those would be like 4 and 5. But I look for a raw intelligence, the ability to move quickly, and a dedication that I call an obsession. And I may get to this later in Europe. The fact that in France, and maybe it's above 20 employees, I cannot email an employee after 5 o'clock is comical to me. I email and text people at 2 a.m., at 5 a.m., and they may hate me, but they know I'm dedicated, I'm obsessed, and I'm working. But why don't I go back to your days as an entrepreneur and as a VC and Angelo's big three. How would you reconfigure that, add to it, take away, and why?
Yeah, for entrepreneurs, my big three would be similar. I would put number one, it's never say quit. So you're doing whatever it takes to further the company. And closely behind that, it's actually one and two are the same, are critical. It's the integrity and character, the personal integrity and character of the founder or the founding team, because they could build an incredible company, but if they're not fully integrous as a human, there's all sorts of ways that they can screw over their stakeholders, whether that's, me as an investor, or whether that's their employees or customers, or, any number of things. So I think grit and integrity are most important. And then the third one that I'll add is, if I'm looking to invest in a founder, do their values and their mission, their stated values and their mission align with mine as an investor?
I like it. I would say yours probably even is a little more foundational, but to push you a little bit, without intelligence, speed, and the ability to be obsessed and be 18, 19-hour, 20 hours a day, sorry, your ethical attitude and your, even to some level, your grit, it just won't be enough. You might be able to survive. You might be able to have a job. You might be able to even be okay, but you're not going to be the best that you could be. And what I always tell people when I speak to universities, shockingly, they allow me, because I talk a lot of shit about universities and the educational system. Luckily, they don't go online and see my stuff. They just look at me as being the family office guy who, let's invite this guy. Don't just be yourself. The reality is, for maybe 1% of us, that's enough. For the majority of us, be the best version of yourself and start that today. And that's a little harder said than it is actually done. So what has been the common traits when you combine your list with my list that you see, including some of the amazing people, billionaires and decabillionaires that you've met? Is there one thing that really rises to the top when you get to meet them or know them as a poker player that you identify in their psychology and traits?
Well, I'm not sure if this will directly answer your question, and you can help redirect me. But what came up when you mentioned what you did was, we need to add a fourth, I guess, and a fifth, which is what you said is raw intelligence or creative problem solving, right? So they have to, be pretty smart, I would say. Although the caveat is, I would rather have someone that had my three qualities and relied on other people around them to make up for the raw strategic intelligence, say. And then, oh gosh, I lost the train of thought. But why don't you respond to that, and we'll see if we can triangulate on it.
Yeah, I mean, I look at given my role in the family office community for years and traveling the world and going to all these incredible places and getting to know some of the most famous people on earth that are billionaires, and the research that I do. And one of my traits, I don't necessarily think it's great for being an entrepreneur, but it's great for my discussions with you and others, is I'm very curious.
Yeah.
And I don't know if I've ever met a self-made billionaire that wasn't notably on the higher level of intelligence and IQ. And I know, oh my God, sensitive subject, let's not talk of it. IQ is not real. Bullshit. It is very, very real. That doesn't mean that they're a good person. Doesn't mean that they're a good son, mother, daughter, father, lover, whatever you want to say. But yes, I'm sure there's some, maybe Richard Branson and some others don't have 140 plus IQs, but they're able to connect the dots, be very diligent, and they have that obsession thing down totally pat. But for the most part, that is a commonality of a trait that I notice. You pick it up very, very quickly, not just their rote memory. I mean, now AI could do that. Their ability to toggle various strategic ideas and then pinpoint what's going to be applicable for them to act and move forward on is notably above average. So I heard somewhere where Eric Schmidt, who's only worth about 20 billion, and he's like, oh, it was no contest. Sergey and Larry were notably higher IQ and more intelligence than me. It was almost embarrassing for me, but that incredible intelligence sometimes lacked a little bit of productivity, of emotional intelligence, or relating to the team and building culture, where I was a great fit as the CEO. And I don't know, Eric's definitely above average intelligence. He's not a 110 IQ. But like he said, he goes like, I'm not Elon, I'm not Bill Gates, I'm not Sergey, I'm not Larry Page. Those are in a special category, at least as tech deca billionaires, centa billionaires.
Yeah. No. Okay. So you bring up some really good and interesting points. I think the quality, one of the qualities that speaks to what you're talking about is growth, oftentimes called growth mindset. And I think that encapsulates the curiosity. So always being curious and willing to learn, and you don't have it all worked out. So ability to learn, there's humility in there along with the curiosity and that growth mindset. So that's one of them. And then the other thing that comes up for me is this idea of either multiple intelligences or thinking about it as a scale of competence. So you're familiar with, I think it's Howard Gardner's idea of multiple intelligences. There can be people high IQ, and then people are really musical, and then physical intelligence, et cetera. I think he outlined 8 of them, but I think it goes well beyond that. And so there might be something like a scale of competence or intelligence within entrepreneurship, where you might have somebody who's really good at, I don't know, corporate business life or accounting or whatever, but that's not the same thing. And there's something special about entrepreneurship that I think there's a competence in that, and there may be an innate component. There surely is an innate component, to it, but like everything, there's also a developmental.
Oops, Rafe, you might be frozen. I don't know if you know you're frozen. There you are. Okay, you froze for a second.
Where did you lose me?
About 10, 12 seconds ago. You were
Okay.
probably concluding the comment.
Yeah. So this idea of scale of competence within entrepreneurship, there's I would say a native intelligence. You might call that, a native component, which is intelligence, specifically within the entrepreneurial activity. And then there's the part you could learn or develop.
Yes, although some people's capacity relative to their pure, let's call it horsepower, is simply greater than others. And again, that does not make them better people. If anything, in some ways, it may make them more tortured. But I'll save that discussion for one of my battles and debates with psychologists. I'm going to ask you a question. Boy, this is going to be great for a clip. So give me a punchy answer, and then we can worry about the long form. I want you to tell my audience of family offices and investors, and really everyone, tell us a lie that VCs tell us.
VCs tell so many lies. I think that here's the dirtiest little secret, well-known secret in venture capital, which is that over 50% of the individual venture funds out there lose money for their LP investors. They don't return 1x capital. And even though the overall returns, the overall industry returns are high, relatively speaking, we could argue that they're not high enough on a risk-adjusted basis. I would argue that. But that's a pretty big lie if you're out there raising money from LPs, that the modal outcome, the most likely outcome, if you invest in my fund, is that we're not going to return all of your capital, let alone give you the 3x or 4x that you're hoping for, that I'm putting in my prospectus, is that my target IRR or my target multiple is 3x or 4x.
Okay, then finally, someone from the industry confirmed what I've been saying for years. And I've literally gotten, let's call it hate emails on. Oh, but Angelo, I'm looking at Hamilton Lane and David Swenson said that 30% of the portfolio in VC and it's doing 26%, etc. There could be various points in time, especially back in the day in certain vintages, where that's true. However, what they're not telling you, which you just thankfully admitted to, is all these researchers on, especially groups that basically it's to their benefit to make the returns really look good. I'm not saying they manipulate the math, although sometimes they may. What I will say, there's something called survivorship bias, where if I'm a VC that goes under, or how about this? They send me a note or an email wanting me to report numbers, and my numbers suck, and I don't want to report because it sucks. Therefore, it's survivorship and effectively success bias that skews the actual numbers. And let's not totally dig VCs into that. That does apply to others, but VCs are probably the ones who are the most high home run, high strikeout hitters. So it probably is going to apply more to them than hedge fund and definitely more than private equity. Thank you. Someone admitted it.
Well, it goes deeper than that. I think it's worth exploring. There's a structural reason why this is the case and why they continue to have to lie or continue to have to be deceptive about their return profile. And that's because they use the 2 and 20 hedge fund model that is not really appropriate for these long cycle, high risk, high reward, illiquid assets, meaning venture capital. And so if you think about just the incentives, well, I'm making 2 and 20. If I'm raising $100 million fund, let's say, I'm going to make $20 million over 10 years in risk-free fees, the 2%. And then I'm going to have a free roll, as we call it in poker, meaning I have no value at risk. I'm going to get a free shot at earning 20% of any profits we make. But I'm not really at risk myself with my own capital. I mean, yeah, they say that in their covenants, they put in, a small taste, but it's not going to make any difference whether they lose money for you. They're still going to make that $20 million over 10 years.
Yes, please continue.
Yeah. And so therefore, and also based on the dynamics that VC is a hits game. So, 9 out of 10 portfolio companies end up, going to zero or break even, say. And then that one, you're hoping that it's, more than a 10 bagger. You're hoping for a 100 bagger, right? The unicorn, so to speak. You're hoping to have this one big monster hit that makes up for all the losses and then some. Well, just by the numbers, by the law of large numbers and the statistics, which are very well known at this point in the VC landscape and the angel investing landscape, it doesn't happen often enough for the average fund to actually return 1x capital, let alone multiples. And there's a very simple fix to that. If a venture fund, and most standard venture funds, they invest in roughly 10 deals per year, 10 new deals per year. So on a 3-year investment cycle, they'll invest in 25 to 30 portfolio companies. Well, if you look at the math and you look at all the empirical evidence, they're under diversified by a full order of magnitude, meaning instead of having 30 companies in your fund, you need to have 300 companies in order to get to that industry average of a 3x multiple.
Is an applicable question, assuming they'll tell the truth, are you eating your own cooking? If I'm looking to be an LP and whatever, you have 2 or 3 different funds, how much of your net worth, is that fair to ask in terms of does the GP have in their own funds and including maybe sidecars, directs, etc.?
They won't tell you their net worth, let alone what portion of it. There's usually in the covenants and the documents, there's a GP commitment, and it's something like 1%. Right. So it's not of their net worth. It's like 1% of, of the fund's capital. So, but it's, maybe sometimes less than that. It varies.
Wonderful.
The point is they're not invested in the same way. Their interests are not aligned with their LP investors. Let's just put it that way.
I mean, yes. I mean, that's basically what the question comes down to. And I believe the math off the top of my head, what is it? One in every about 500 becomes a unicorn. So if you do the math to the number of entrepreneurs that a VC fund is investing in, you may get lucky and get into the right one, or they may get lucky. So then that brings up a very important question. And again, I'm a real allocator, a real investor. I've lived through being an LP, being a direct investor in privates, controlling interest. I think that makes me a little different from others in the family office world, but you'll have to decide. I am a big believer in high conviction in public equities and in what I do in privates, especially if controlling interest. I want to really understand it and maybe even roll up into given territory. But the one, let's call it sector, the one sector where even the pros can't do it right, where you may need massive volume, is going to be the world of earlier stage. You would call it angel, maybe one level above that. To think that a family office, unless they really have an incredible internal team that gets lucky also, how are they going to find that 1 in 500 that becomes the unicorn? What makes them better than the VC, who's probably not so good to begin with?
Incredible set of questions. And so I'll start with another, let's say, misconception in the VC world. By the numbers, and you can verify this for yourself with publicly available data. When you actually crunch the numbers, it's not unicorn investments that drive the average high IRR in the space, in the marketplace. It's actually singles and doubles, meaning sub $100 million acquisitions are the bread and butter of overall returns. The problem is that if you're playing with a small number of portfolio companies, you actually need to have a large hit in order to make up for all the losses that come with. You're going to get a single or double most likely in a maybe a few singles and doubles, but it's not going to be enough in the standard batch for VCs in order to make that top quartile performance, let's say. And so then what can you do as an LP? Well, I'd say there's two things. You can either become more of a smart money LP, by which I mean simply diversify not into one or two or three individual early stage venture capital funds, but 10 at a time or more. So it's just about diversification. Okay, so if you're going to be an LP, just be a smart LP, and you do the math, and it comes out to invest in 10 funds, not one or two or three funds.
Okay, so now I'm going to have some follow up on that. That's a lot of diligence. That's a lot of things to manage. That's a headache, at least in terms of from my perspective. And if I want to get into Andreessen Horowitz, a Sequoia, a big monster, and I'm not already an LP, I could be $1 billion family waving a $10 or $20 million check. I might get laughed at. I might literally get laughed at and not even get in the door. Therefore, is it concentrated to bigger is better on like maybe hedge funds, but that might be the case in VC? Or are you saying go more to smaller funds, but you're giving me a lot of work now?
Yeah. Okay. All right. So this comes to the third misconception or lie or deception, which is VCs at the early stages cannot pick the winners from the losers better than you or I or a monkey with a bottle of tequila and a dartboard.
I'm going to go with the monkey with the tequila and the dartboard.
Because they don't have the bias, right? They don't have the various different biases. right? I'm with you. So given that, right? So if we're acknowledging that there's just so much volatility and risk and uncertainty in the early stages where the returns are the highest, right? If you want to play private equity and move up the stack, that's fine. And then you can pick winners, and then you can make winners, and you can do roll-ups, and you can take controlling interest. That's called private equity. But we're talking venture capital really is about early stage innovation, high risk, high reward. And so when you're in that kind of environment, and we know this from Wall Street, we know this from poker, we know this from all sorts of similar types of games, and I consider them all games. You're going to have to diversify. And so you say it's a lot of work. Well, if any manager is just as good at picking winners at the earliest stages as the other, you don't need to get into Andreessen. You don't need to get into Sequoia. You can pick anybody, frankly, who has a reasonable process and has the backing of other family office investors or other LPs that have done the diligence. You don't need to do it yourself. Coattail behind somebody else who's done the diligence and says, look, we're going to give this emerging manager a shot, but we're not going to just put all of our allocation into one. We're going to spread it across 10 or more.
I'm not sure I want to say it because I'm giving away a little bit of one of my secrets. Now, if you pay me as a member or a consultative relationship, I'm good. You get all the secrets. Is it a little bit of a hack or a trick to whatever? I subscribe to PitchBook, which is a lot of money, by the way, but I'm able to see what these incredible, or Crunchbase and or both, and what Eric Schmidt's family office is doing, what that family office is doing. Oh, they're in these sectors. They might be in these funds. I want to see if I can get in there. I think pretty highly of them. They probably did the heavy lifting. I may not have the money to be the minimal that opportunity needs, but I got some directional opportunity in terms of what you're doing. Is that a good idea, a bad idea, or you're neutral on it?
I would say I'm neutral on it. So I think the nugget in what you're talking about is, there's a lot of different sources in terms of deal flow. In terms of, so if we're talking about picking managers, that's one thing. If we're talking about picking portfolio companies, so that's another thing we can talk about, is how a family office can actually run the VCs and run a direct strategy, a direct money ball strategy where you're massively diversifying, and do it for a fraction of the cost that a VC firm does it, because you're not looking so preciously at each and every one of the individual portfolio companies. You're doing basic screening on let's say the big 3 or the big 5 qualities that we talked about, and then you're pulling the trigger and you're just being prolific. I call this Moneyball after the book of the same name.
Okay, so
it's quantitative. It's like when Wall Street went to quantitative investing.
Well, you opened up a big door there, so of course we're going to have to just jump right in it. There have been organizations. I've known Dave McClure back when he was at 500 Startups, which really was more like 1,400 startups.
Yeah.
We both know, at least me, one of the principles of right side capital management. These are all organizations that may be invested in more earlier stage entrepreneurs via Silicon Valley and Dave around the world than really anyone else out there. Now that you said maybe as a family office, we call it, by the way, and I've done some consultative work with families on creating their own venture studio and their own economic interest in terms of what they're doing. Most people are going to push back on you. Now, again, I say, who's pushing back on you, family office? It's probably an existing VC that doesn't want you to be a competitor. So know what someone's conflicts are. That being said, I can't say it's easy. How do you get out there and get enough deal flow to potentially make small allocations to dozens or hundreds of companies?
Yeah. Well, You said yourself, you can subscribe to PitchBook, Crunchbase, right? But these days, all the information is out there. Like, using AI tools, using search engines, using various different databases. One of my hacks that I love is just coattail off of the accelerator programs, right? So Y Combinator, Techstars, 500. There's a number of them that do high volume investing, and they're effectively playing Moneyball. And Right Side Capital, which you mentioned, they publish their portfolio companies on their webpage, and so they have no problem. In fact, they love it if people coattail off of their investment. So using what you talked about earlier, using signals from all the VCs and who will publish. But even if they, if they don't, there's lots of ways you can find out about startups. You can even put it out there on your own website. Hey, we're taking applications. We have a Moneyball style fund. We're doing allocations at rapid pace, and here are the criteria, and apply now. And you get to choose. You get to filter out whoever you don't want, and you get to respond to who you do want.
At the early stage or maybe a mid stage, could I make the argument? One family principal in Palm Beach told me maybe 2 years ago, Angelo, it's an insider's game. And I knew what he meant. He might have embellished that a little bit. He basically implied the star makers, maybe a Peter Thiel, maybe the Techstars or Y Combinator. In theory, could they make a billion-dollar company? Could they make a unicorn? And do they have insider's edge that me or others will never have?
So yes and no. So there is a game that is being played that is an insider's game. It's not in picking the winners. It's about making the winners. It's being kingmakers, like you said.
Yes.
And so, yeah, that's an insider's game. And yeah, you're not going to get in that club. And that's okay, because there's another game that's simultaneously being played that's very playable, especially these days. Maybe back 20 years ago, it wasn't as playable, but these days it very much is. Where again, you're playing Moneyball. You're not looking to pick winners. You're looking to harvest winners by massively diversifying, playing the numbers game, playing the quantitative game, and aligning your investment thesis, meaning the filter that you're using, along the lines that we've been talking about. Number one is, what do I absolutely have to have in a founder or founding team in order to be in contention? And then number two, if I'm looking to make impact in a particular sector, right? Maybe whether it's sustainability with the environment, or whether it's poverty, or whether it's clean drinking water, I can have all of my different theses as my values lens. Say, okay, within the universe of investable founders, which ones am I going to choose for my portfolio? And then again, you're looking for diversification. So I'm advocating for, and there's nothing wrong with playing, pick the winners game and really concentrating. I know that's one of the things that you like to do. That's a great thing to do. And there's also another way to do it. And I'm just making that case because it's the lesser known case. We can talk all day long about the concentrated approach, and I'm a believer of that as well.
Of course. And we do have a lot of things to talk about. So one of the things I think that is maybe understated, it's going to sound a little weird to some investors. America is a very special place. It's from a cultural perspective, I don't have my 10-gallon Stetson cowboy hat's about 20 feet away. The American spirit of entrepreneurship, of trying, of failing, of getting up, of being resilient, of being gritty. Other parts of the world, for the most part, don't have it. I like the fact that I'm supporting entrepreneurs that have that dog in them, as the coaches say in sports, that are willing to grind it and take the risk. I'm supporting things that are often positive for this country and around the world. And maybe at the end of the day, it's extra work for me. And I look at it and say, geez, I probably should have put the money into triple Q, go to sleep, be totally liquid, and probably get better returns. I mean, let's just be real. But the excitement of being in the game, like being in a poker game, the chance of maybe getting that Peter Thiel investing in Facebook and becoming a billionaire just on that alone, which of course we basically have no chance of, especially now. That was 17, 18 plus 20 years ago now, actually looking back at it. Wow. So therefore, is there something special, almost magical about Silicon Valley, even Boston, New York, Austin, Boulder, Miami, and basically, and I'm not to say, Israel and other parts of the world, parts of Germany, but for the most part, the Americana spirit of entrepreneurship appears one of the greatest advantages to the US.
Yeah, I agree. There's a cultural component that makes it really much easier. It gives you tailwinds as a founder and as well as an investor. So it's something about the culture, not only of the American culture, but I think there's something special about the Silicon Valley culture. And where you're going to find that most concentrated is in Silicon Valley itself. But as we've seen, the Silicon Valley culture and way has migrated outside of Silicon Valley itself. Los Angeles, Seattle, Austin, Boston, Boulder, Miami, and of course other countries, right? I mean, there's a book out about Israel as startup nation. So there is that, but you're right. It's a cultural piece, and it is an advantage, and it is. I think it is pretty distinctly American. I agree.
100%. I wish I wrote it, and I wish I had proper credit for the person that did. I'm going to read it to you in a second, Rafe. It's pretty quick, probably about 20 seconds. It's going to cut right to that point. And for those of you that follow me, know that I have been critical of Europe, broadly the continent. There are some countries that get it and are great. By the way, incredible culture, architecture, food, amazing people, beautiful people. I just love going to Europe. It's awesome. It relates to some of my cultural heritage on my Latino, or really more applicable, Spanish and Italian side. And I did my DNA test. It's mixed in with a bunch of other shit too in Europe. So I'm a true mutt. But I'm going to read this, and this is really going to nail it home. So if I get more hate mail from Europeans, so be it. Bring it on. While Europe debates the ethics of AI, America builds it. While Europe regulates cryptocurrencies, America, especially now, is innovating in it. While Europe protects old industries, America creates new ones. Europe has become a museum, great at preserving the past, and that is awesome. Terrible at building the future. Unless Europe slashes regulation and enhances culturally risk-taking, the gap will widen. I find that to be, wow, I wish I wrote that. That was so good.
Yeah. I see that. And to me, the summary is very simple. Europe is a risk-averse culture, whereas America is a risk-seeking culture.
I mean, in short, yes. Now, does that sometimes cause us to crash and burn? Do we quite have the safety net? But there's one of my Angeloisms. I don't think I'm the only person that says this too. Most people, actually, even in America, most people would exchange proverbially bread for freedom. They just will. A sense of safety, of comfort. Give me my 3 weeks, 4 weeks off in Europe, a safety net. And I don't need to be great. I don't need to push boundaries. Is it true that every trillion-dollar company, now Buffett's is right below it, but every trillion-dollar company originates or has a strong base from the Bay Area through Seattle? Now, technically, Meta was founded outside of Harvard. I get it, but it did its growth in Silicon Valley, obviously. And Saudi Aramco did have initial offices and structures in San Francisco. Admittedly, I'm pushing that boundary a little bit to make my narrative fit. I do understand that. But whatever it is, $7, $8, $9 trillion companies, boy, there's got to be something to that besides big tech. Basically, Silicon Valley through Seattle. That's like a crazy statistic.
Yeah. I mean, yes, I guess that is a valid statistic. I would be interested in like how many billion-dollar companies are relatively speaking from Silicon Valley versus elsewhere. And I think you'd see a lot more spread. Another way of looking at it is, and I don't know if this is a recent stat, but when I last checked, of the S&P 500, only 20% of the market cap is from venture-backed startups.
Wow. I
So
didn't
that might
know
have
that.
changed. That may have been, they may have concentrated, more recently. But look, half. What's the other statistic? Main Street businesses, small businesses account for, I think it's still over 50% of our GDP.
Right. Correct. And
And
some
there's
of
like
those,
50, 30 million, 40 million of those in America.
yes. And that's one of the opportunities is many of them are owned by baby boomers that are exiting out. Now, yeah,
Yeah.
you're not going to get 100x on these kind of investments, but I looked at septic tank companies in the Midwest and Wyoming, rolling up fencing companies. These are good, solid businesses. People need to be employed. They provide value to the community. They're a little bit recession proof, or maybe a lot actually, and it's a good, steady growth. It's not
Yeah.
super exciting. Could I probably get more? And I am, either through the triple Q or my individual stock picks. Yes, definitely through Bitcoin, at least lately. But again, it's deeper than just strictly on liquid. And it's a diversity in tough times. And I also think doing the right thing. But that's a subject for a little different time. I think we do have to relate it to VC, and really a lot of our discussion segue a little bit into, I'll make a bold comment, and you may disagree, which is great. Actually, it makes for better clips too. I say, and again, I know I'm a little contrarian and kind of an outsider now in the family office world because of some of my Angelo crazy thoughts. And by the way, all that hate I got years ago on Bitcoin and crypto, I might have been a little off in 2022. My timelines could be a little off too. I'll admit that. You should have listened, especially in Bitcoin, Ethereum, and Solana, but definitely how Bitcoin's been lately. And now that you're going to see the opportunity for governments to get more active in it, for institutions to feel more comfortable and be long-term in it, I think you're going to see a significant rise on it. And the majority of family offices, you were wickedly too close-minded and way too damn slow. I'm gonna beat my chest a little bit, just slightly on that one. I kept quiet for 2 years when it's actually quietly doing very good, but now I'm going to be a little more vocal about it. We're going to come back to crypto. Here's my stark comment. AI is underhyped. Agree or disagree, and why?
Okay, before I do that, I'm going to answer the question. I need to go back to something that you teed up and I didn't fully address, because I think it's going to be important for listeners. We talk about this massive diversification Moneyball strategy, which is quantitative and kind of boring, right? It's not as exciting, right, as going all in and really helping, a founder that, they're onto something really big. They're making a huge impact. And so here's my answer to that. You can have your cake and eat it too. Have a Moneyball strategy as your base, and then pick 1, 2, 3, 4 companies within your portfolio of hundreds that you're really going to spend your time and energy and your heart, and you're really going to help those founders, and you're going to work on M&A, and you're going to work on roll-ups, and you're going to work on strategic partnerships, and you're going to be on their board, and you're going to really advise and mentor them. I think that's the real winning strategy. So, for what it's worth.
Mm-hmm.
Okay. AI.
Now I have to set up our clip again,
Yeah.
Rafe. But thank you, Rafe.
Okay.
Do you think that AI? My opinion, AI is underhyped.
I'm going to have to agree with you wholeheartedly there. In the following sense, those of us who have been in and around AI, we know that the future is going to look radically different because of AI than it does today. And what people have seen in terms of large language models, OpenAI, ChatGPT, Anthropic, even the Google version of it, it's really cool. It's a magic trick so far, but we're kind of topping out in terms of people's ability to deploy AI meaningfully in their lives, in their businesses, especially at the enterprise level, in terms of what the technology that's here today. There's going to need to be, and there is coming, a next level jump, just like we saw with the internet, right? Where it's not just this base technology that lets you do things that you weren't able to do before, but really nuanced architectures and applications of AI to specific big problems or industry problems or specific small problems. That is a quantum leap in terms of the performance and also the efficacy of utilizing AI to transform businesses, industry, government, personal life, just about everything on the planet. So I agree with you wholeheartedly that we're just scratching the surface of what's coming in AI. And part of the problem in terms of understanding where to calibrate, are we going to, is this underhyped or overhyped? It's hard to think exponentially for human beings. The kind of change and kind of progress and kind of results that AI brings is a quantum leap. It's exponential. It's not linear. So it's hard for us, our minds, to wrap around it. So I agree with you. Long-winded way of saying it's underhyped. We have no idea. It's hard to predict. We can't predict how it's going to change, but we know it's going to change things fundamentally, very quickly.
I mean, you look at Jason Wong of NVIDIA saying that it's doubling in terms of its quote unquote energy and power every 1.03 years. Do the math on that. I think 1,000x is more powerful in only 10 short years. Look at the opportunity and the usage of energy. Now that gets complicated, but you're seeing certain regions and countries, Saudi Arabia, China, doing a lot more on nuclear power. One of the things I've been talking about for my members on an investing perspective, some public, some private, but not for our discussion today. And I've done debates and things on the future of family offices. In the future, I'm talking about like 2 years out to 2030, really not that far out. And basically, and again, I think I'm pretty good at being creative in a very boring industry and seeing around corners. Admittingly, my timelines are sometimes off, but I inevitably am almost always right. But isn't everyone if you give it a long enough time horizon?
Not everybody. No, you have a skill. You have a special skill.
I mean, I see everything in the world of government, of finance, of manufacturing, healthcare, through the impact of AI, robotics, to some degree, quantum computing, and a little bit of blockchain. This is way bigger, by the way, than my conversations years back and getting people into Bitcoin, crypto, and blockchain. But coupled with everything that I just described, maybe throw in energy and one day fusion energy that may be super intelligence from currently where we are to AGI to super intelligence. All of that may come to fruition, according to Kurzweil, maybe 4 to 5 years. Okay, let's call it 10, 12 years. Like a family office as we know it, and investors and hedge funds and how they exist, everything could be flipped. I'm going to ask you a scary question. And no, it's not going to be the end of the world and all that. Although, yes, I could talk about that dystopia as well. I almost don't know if that's not inevitable within probably 20 years, but I don't want to scare people. There are things that could be more positive, and we'll stay that. My question is, if you're gonna make a lot of money, we all define that differently. Let's say someone that has really big dreams. You better make it in the next 10 years. I think there'll come a point when either governments or people that are trillionaires may control, quote unquote, control is a loose word, AIs that give them the slightest edge and they just steamroll pennies and nickels all day. That comes out to real money. Am I being a little bit over the top about it, a little too dystopian? Or Angelo, you're onto something here. Go make a lot of money now.
So I was learning about your concept of sovereign optionality. I really love it.
Someone's reading my white papers.
Yeah,
what's wrong with you?
It's a great. Everybody should read that. It really is incredible.
Thank you.
Yeah. I look. I agree with you that it's really important to, in this moment of time, reflect hard on the nature of money, right? If you're asking the question, I want to make a lot of money. Well, if everything is denominated and settled in US dollars, and, this isn't a huge stretch, what if the dollar soon no longer holds its reserve status globally? Okay. What if there's a hyperinflationary event in the US? It's not that far-fetched. So if you're holding dollars and dollar-denominated assets and dollar-settled assets, making a lot of money and then having it go up in smoke in one way or another, not to mention, I'll just complete that thought. It's really important that you think about the diversification, but not only the standard diversification that we talk about in finance, but sovereign diversification, different forms. You talked about, holding gold, but physical gold, different jurisdictions, real estate, of course, but digital assets too, and different kinds of digital assets. Equities, public liquid equities as currency, private equities as currency. So all of this stuff are possible to meet the definition of money, store of value, medium of exchange, etc. I like to think of it in terms of I'm building a portfolio of value that is resilient to any kind of exogenous shock, hopefully. Anti-fragile, if you will, to put it into Leb's terms. And I like to think outside the box and creatively about what could go wrong. What's like this worst case scenarios? Because if you think about it, then you might be able to hedge against it in some way in your portfolio.
I mean, I always thought about that. Then early in COVID, one of my relationships reached out with a Forbes 10 family that's big tech, now certainly a centa billionaire. And that basically was a concern. And that led me down a rabbit hole of doing a modest consulting assignment that I've added to and built up and really created a masterclass, one that I think is pretty brilliant, sovereign risk and disaster preparedness, and talks about things like gold, like Bitcoin, like Web3, like ownership of art, like diversity and sovereignties, like looking at what's happening intriguing in Argentina and other countries and trying to see ahead to 1 year, 3 years, 5 years out. Things change. Speaking of Argentina, 120 plus years ago, they were kind of near the top of the world. And then they hit massive period, effectively a century. Again, great architecture, food, people, amazing, great steaks, cigars. Man, I love Argentina. And now they appear to be going through a change that I think is going to be hard medicine, but is the right move. I don't know what's going to happen, especially in today's faster paced world. 1 year, 5 years, 10 years, 100 years. Read Balaji Survivansons. I always mess up his name. I've reached out to him several times. He says he may come on one day. I'm probably not a big enough platform for him. He's one of the co-founders of Coinbase. Rafe would be familiar with who he is. Probably a billionaire on paper, very active in Bitcoin, and a really, 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 really smart guy. I actually disagree with him on a couple of things, but we're going to get a little off track there. But one, thank you. And by the way, when I talk about that subject, when I talk about these things, when I talk about what I'm describing on AI flipping things, 99% of my audience, they may enjoy some of the surface level convo because it's a little different and exciting. They really don't care. I'm just being honest. Probably 90% of my members just want it to be even a little bit more traditional, transitioning to the next generation. What are some opportunities, including gold, to get involved in, learning a little bit about art, but pushing the boundaries of crypto and Web3 and AI. And by the way, making massive amounts of money in the public markets and AI plays. I've had phenomenal multi-X returns, not even talking about the Mag 7. And these are all things I talk about, but kind of people don't really think for themselves and take action. So it's a little sad. And that makes me a little bit of the outspoken outsider that I used to be the insider back in my family office association days. No beard, was a nice boy, obeyed, went deep state family office. And to others, I went off the reservation 4 years ago, becoming a little bit of, in my version, my own variation of a savant. And that led me down the road of making a lot of mistakes, by the way, but doing a lot of things that also, or some things that worked out incredibly well, and having an opportunity to just think out of the box in a very, 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 the VC industry is somewhat creative. The family office world, for the most part, is not. I'm going to ask you a very tough question, but you're not really raising capital. So just give us an honest answer. And don't give me a politically correct answer. Some are great, some are good, some are okay, and some suck. In general, what has been the vibe of the big players in VC, the biggest of the big, and some of the billionaires and others that you know? Are family offices sometimes looked at as being a little bit behind the times, a little bit of the stupid money? And although I say a lot of shit about institutional investors too, uh, are family offices really not so good on a lot of their processes, systems, and what they do in investing?
Well, here's what I can say that I can speak from experience about is family offices are the lifeblood of the average venture fund. And so
smaller one, sub half billion.
Yeah. I mean, yes, you have, you have the really big boys who have, sovereign wealth, and they have endowment capital, but the VCs need LP investors. They absolutely do. And so they, the way that they look for the most part at family office investors is they're hoping, just like the entrepreneurs are hoping to get the VCs money, the VCs are hoping to get the family office money. The vast majority of them, right? And we talked about that's a sort of a concentrated. Everybody wants to. All the family offices want to get into the top echelon firms that they're competing over. They love that, but the reality is, if you're looking to make money in venture capital as a family office investor, again, like we talked about, let's go to the bread and butter. Let's spread our bets around across different managers, and I think that from that perspective, there's an opportunity to make those relationships true partnerships.
Okay, I mean that's a pretty politically correct answer, but I appreciate it. And you're not incorrect. If you're an earlier stage VC, or even definitely probably even 100 or 200 million, high net worth investors and family offices are going to be your bread and butter. And of course, some of them will be wonderful investors. But like anything, there's going to be an average. But I think for family offices, what are you comparing to? Because it's an opaque industry. Maybe your friends in the community are basically along with you. Maybe you're a little better from them. You might be the best of a bad lot. But how about you look at some of the incredible family offices in the US and around the world and know that there's work to be done? And no, size is not the only determining factor, although it may give additional resources for talent and systems. I've always said, and again, everyone hates me for it, even at 1, 2, 300 million, you could do a lot of damage. You might even be able to be more nimble, less hierarchical, less bureaucratic, make quicker decisions. And some of the software and tools in AI, the prices are going down, down, and down. So don't use, oh, we're not really that big as an excuse. I think it is an excuse. And there's no reason why. And if you read my paper, I talk about how 3% of family offices, I admit there's some more than some qualitative perspective there, are really great, but many of them could be good to very good. Some of it is productivity and other enhancements that I work on, and really no reason why that often can't happen in really a couple of months. Now, that little extra chasm going to great, that's a little harder. I spoke earlier about intelligence and speed, and there's some philosophies on employment and relative to things in the family office where it is going to be difficult, but you could be way better than average no matter how we define average. I want to ask you, I'm going to go with a couple of different questions. We're going to go a little bit to poker, a little bit to VC, a little bit of investing, kind of all in one question. How do you assess asymmetric opportunities? Those where the downside is maybe only what you put in, you're not levered, and the upside is greater. You gave a baseball example before. Baseball actually is not necessarily a great example, especially in venture or earlier investing, because with one swing of the bat, I would need three players to be on base, and the most I could score is 4 runs. But in theory, in investing in asymmetrical opportunities in earlier stage, I may very well strike out. I may hit a single or double, but maybe, just maybe, I could get, you mentioned 100 bagger, I might be able to get 1,000 bagger.
Agreed. Yeah, you're right. There is a vast difference between baseball, poker, and then venture investing or equity investing. And it's because of the asymmetry, but also the unboundedness in the latter. So poker is very clearly a zero-sum game. For me to win, you have to lose, and vice versa. Whereas venture investing is a positive sum game, meaning that entrepreneur, customer, investor, all the stakeholders can win simultaneously. And so it's a fundamentally different type of game. And you're right, baseball, it's also a zero-sum game. And so the analogy only goes so far. Asymmetry is the genesis of the ability to have alpha or any advantage over the average, over the market.
Indeed. Now, there are some advantages too from a tax perspective that we didn't get into relative to investing in private companies, entrepreneurs, earlier stage. And there is, I could argue, in public companies, I'm too tempted in today's world of this and other things to get in and out too quickly, where I'm kind of locked in if I'm in the world of VC and private companies. Sometimes that could be a bad thing, but I'm not so sure that sometimes that's not a good thing. So It does go both ways.
Yeah, I mean, there's a poker analogy here. And what you're talking about, we call in game theory, we call a forcing function. So if you're forced to hold on to an equity, and you're, like you said, you're not tempted to sell when, based on some kind of whim or other requirement, you often have a big advantage. And Warren Buffett talked about this a lot when he was talking about the merits of like a formulaic index fund versus a managed mutual fund. And so in the poker world, here's the relevant concept. When you go all in poker, it's a forcing function. It's a forcing function on your opponent, but more importantly, it's a forcing function on yourself. Because once you're all in, you cannot possibly make another wrong move or mistake in the hand because you have no more actions to take. And so when you're dealing in the world of uncertainty and risk, which is the unifier in both games, venture capital, investing, and poker, it's really important to be able to minimize your mistakes. And sometimes having your hands tied is the best thing you can do for returns.
And again, I promised I would bounce around with things that were completely, speaking of, uncorrelated. I'm going to come back, and we did mention Malay in Argentina. We did mention AI. I'm going to now throw in Elon and make it a little complicated and a little bit of a sensitive issue. But when has that ever stopped me before? I remember reading as Javier Malay of Argentina is making the rounds here in podcasts like Lex Friedman, who did an awesome job. That's an incredible listen. You have to listen to it. Obviously met with incoming President Trump and Elon and his team. And there was something I read to the effect of, in streamlining the government, utilizing from Google to Meta to AI platforms to be effectively not just more effective, but wickedly more efficient. There's a little element of that that's a little scary, that worries me a little bit, being distrustful, although the Meta platform is kind of, let's go with the word, open source. But nonetheless, on the other hand, there is a beautiful efficiency to it and the direction of how things are headed. You're in an area that at one time, even if you were more libertarian, slightly right, you kind of kept it to yourself. And that changed with Thiel, with David Sachs, with Elon, with Tim Draper, who I've known for years. And they're now obviously pretty boldly more, leaning with libertarian first, but obviously somewhat to the right. And I think about governments changing, about the massive deficit that we have, bureaucracy, it's bloated. Man, I'm giving you a tough one here. Do you think that your community, Silicon Valley, entrepreneurs, deep tech, AI, as we're seeing it play out really just in the last year and really the last couple of months, is going to be very impactful, coupled with potentially Bitcoin and Web3 and these government ecosystems? We're seeing that in El Salvador moving forward. And this goes back to in 5 years and 10 years, is everything going to be completely different? And maybe some of it could be a utopia.
Okay. So the question is the Silicon Valley techno-libertarian set going to be really impactful in changing things up, shaking up the status quo in Washington and globally? Was that the question?
Let's go with that. That's close enough.
Okay. Gosh, I hope so, but I don't know. What I will say, which you touched on earlier, is this supposed shift in kind of political alignment or political spectrum from previously left to more libertarian and right. And I like what Elon. I think that Elon's explanation is right on, which is those of us who identify with that ethos, we haven't changed. The goalposts of what it means to be progressive or liberal or democratic has shifted so far to the extreme, to the left, that it leaves people, okay, well, what are you? Well, you must be right. You must be libertarian. It's like, I would say a large number of us are abandoned in the middle. We consider ourselves free thinkers. We're not ideological. And we take it issue by issue. And we take it, present situation to present situation. And so I think there are literally tens of millions of us who are the silent majority of independent free thinkers who believe in the project of America, which is based in representative democracy, and this left-right divide and the extremism. I think that it's a very, very volatile and fascinating time. I wouldn't even hazard a guess. I'm hopeful, to answer the question more directly, I'm hopeful that the new administration is going to shake things up in the right ways and not shake things up in the wrong ways.
I mean, my audience knows how I am about that perspective, and I'm not afraid to talk about geopolitical and economic perspectives. I want to listen to both sides, and damn it, sometimes I am wrong. I do look at the fact that we have a $36 trillion plus deficit. I do think because incoming Trump is going to align with the House and Senate, he'll get more things done. I think Elon is pretty amazing. I do think Doge will have many positive impacts. I'm not talking to crypto. I'm talking about what they're doing in the government. But okay, it takes $1 or $2 trillion off. But how about the interest on the debt? And how about that it's 36 trillion? What Malay's doing, which was very harsh, going from 2,700 in 2,700% inflation down to 2%. But the pain of over half the people effectively in poverty. And to do what a president, left or right, may need to do, I think would be so painful for the American people that whatever that party is in 4 years, they're out. So
Mhm.
I think there is some talk from Trump that sounds pretty good, but I just don't think it's going to play out per se in reality. But parts of it might. And even making a dent and showing progress of change and less bureaucracy could be a good thing. Now,
Mhm.
I am going to latch on to a little bit of Bitcoin being part of the National Reserve or the
Yeah.
whatever, the Federal Reserve. AI and the impact on productivity, GDP, those might play out to be positive things. But to think that our deficit is going to magically go away, I'm hopeful, and maybe some of the latter things I said over time could. But to do what would need to be done by either party would basically cause so much pain. And it's probably the right thing to do, but will cause so much pain that that party would definitely not get elected heading into the next election. Okay, that was a little bit of one of my rants there. Relative to the last question I asked you, uh, JD Vance has a background in VC. He's very close with Peter Thiel, which means he was known for years by Elon, because obviously Elon and Thiel are, at least I think, close. I'm not going to say he's a plant of Silicon Valley and VC in the White House, but I think there might have been a little strong arming of Trump to pick JD Vance. Now, again, we may look at that as being a positive thing. I could also, and is there a little bit of a perspective when I hear people like Sachs and Elon and Thiel, they kind of imply that much of the Mag 7 in the tech world, which is basically all of it, has gotten too big. And they talk about breaking it up, that the parts are worth more than the sum, that we need more competition with younger, vibrant companies to come in. And it sounds a little good on the surface. So, and again, I know I'm asking you questions that you go into restaurants in the Valley. And if one of the people happens to watch this podcast, like, hey, what were you talking with that guy with the beard on? What are you talking about? Don't give away some of the things we're doing here. I don't know. Is Vance effectively a little bit of a Peter Thiel plant in the government? And maybe that's a good thing. And how could it impact antitrust and smaller entrepreneurs? And I'm kind of getting the impression it might be a good thing for VC.
Yeah. I mean, I have to say, I just don't know. I mean, I can see it. I could see it being a positive thing for VC and the entrepreneurial ecosystem. Um, but uh, but I don't really have much perspective on that.
As a professional poker player, how did you mentioned it only once before, but it's your upcoming book. You definitely talk about it because I got an early copy and I read it. Game theory as an influence to you in approaching investments.
Yeah. So I mean, I look at poker. I was a founder, a 5-time founder of early stage tech companies, and a prolific angel investor and a VC. And I look at all three activities as really different versions of the same game, which is making lots of strategic decisions under conditions of great uncertainty, risk, and with high consequences. That's what unifies all three games. And there are principles. We talked about one of them, forcing functions. We talked about another one, optionality, which are foundational to all game theory. And then there are very specific game theoretic concepts in poker that apply to investing. Things like selective aggression, right? So be selective about what companies that you're going to invest in, but then be aggressive. Like, don't spend all day, don't diligence a company to death. Be able to pull the trigger on an investment decision, or in poker, a bet. All right. So selective aggression is one of them. First mover advantage, last mover advantage. There are both in Silicon Valley, and there are both in poker. There are advantages to being the first person in the pot to get all your chips in, structural mathematical advantages, as well as psychological advantages. And there are structural advantages to being last in the pot. Namely, you have all the information that you need. You have more information than your opponents. So there's so many parallels that I actually opened the book. The book is called The Future of Venture Capital, How to Win the VC Game and Make Positive Impact. And I open the book with a game theory primer, how these very principles that I was talking about from poker apply directly to venture investing and other forms of business as well.
You talk about in the book, and when I'm looking at some of the public company investments that I make, I look at what I call supply and demand in a given market infrastructure. I look at quarter to quarter growth, and I look at to see if they're kind of a monopoly slash moat. I actually think there's nuances of difference there, but I know that you have a little bit of a unique perspective on a defensible moat for AI companies, in some ways feeling that you're not so sure it's there. If you could elaborate a little bit about that.
Sure. So I'm gonna see if I can come up with an analogy from like the early days of the internet. Yeah, here's an analogy. There were a number of companies that were web hosting companies in the early days of the internet. Some of them grew to be really big, but at the end of the day, those are commodities, right? My web hosting services are no better than your web hosting services. At the end of the day, it's a race to the bottom. The same thing with computing power, right? And then the same thing with these large language models that are undifferentiated. They're just kind of taking all the computational and pattern matching power, and there's an arms race going on. Is who can spend the most money on infrastructure, on the chips, on the power, and it's a land grab. It's unclear whether OpenAI will ever turn a profit, for instance. And so if you're trying to compete with AI applications that are, let's say, not defensible, and I'll explain what I mean, you're basically betting on a commodity that's a race to the bottom in terms of price and performance. What would be defensible? Well, I think what's defensible in terms of looking for AI investments is not to look for AI companies that are solving virtual problems in the metaverse. What I mean by that is software problems. But if you have an AI company or a technology that's embedded into a real world brick and mortar human based business, especially one that's already good enterprise, and you're looking to transform that business using an AI application, that's a good bet. Or if you're looking to disrupt not a virtual business, but a real world brick and mortar human business, or come into the marketplace with a new product or service that's human first, that's brick and mortar first, and AI second, that would be defensible, in my opinion. So that's my caveat about investing in AI. I'm a huge, long believer in utilizing AI in every aspect of your business. But just be careful about investing in something that doesn't have a defensible moat from a business perspective.
Oh, those are very good points. And sometimes, yeah, you don't want to be a trader, but the days of maybe I'm going to buy this stock and hold it for 20, 30 years, that sounds great in theory. And sometimes that may absolutely be the right thing to do. But in today's world, with things changing so much, I just think that's very, very hard.
Yeah. I mean, Eric Schmidt said in one of his not too long ago interviews, he pointed out that by the time you listen to this podcast, his podcast, it will be possible for somebody in their basement using an OpenAI tool to recreate all the functionality of TikTok. Right? So what's defensible about TikTok is not the technology. It's not the functionality. It's the fact that they have so many resources and so many users currently.
Yeah, a massive network effect of what 600 million users that are comfortable and lethargic being on the same platform and probably not going to change.
Well, they might, and it happened, multiple times before. You remember the first social network was not Facebook,
Of
right?
course,
Right. It
MySpace.
was not even MySpace. Do you remember Friendster?
Well, you're a real G. You've been around forever in the community. What was it?
It was Friendster.
Oh, Friendster. Okay. Yes.
And Friendster, got to tens of millions of users. It was blowing up so fast, and they had technology problems. They couldn't scale fast enough. And overnight, all their users migrated to MySpace. And then
we know what happened to MySpace.
Seemingly overnight, because MySpace had had problems with their user interface, sucked, and they didn't have real names. People didn't like talking to anonymous people, and your interface sucked. And Zuckerberg, he solved both those problems very, very simply, and really overnight. If you think about it, all of those users and more went to Facebook, right? And so the same thing happened. And then Facebook, it goes to Instagram, and it goes to TikTok, Snap. So there are no defensible moats, even though it seems like a TikTok owns the world. They're very vulnerable.
That's a very good perspective. And by the way, audience, laughable that I thought this would be an hour-and-a-half interview. Rafe, I'm sorry, I'm keeping you from God knows what. At least let's go to the top of the hour. We're rolling, lots going on. A little bit related to that story I was going to bring up, we'll just jump into it a little bit now. Effectively Facebook, aka Meta. What is it? Across all their platforms, 2 billion users. That's like 1 in every 4 people on Earth, and only growing. It's no wonder. Now put on your crypto hat a little bit. A couple of years ago, when they were rolling out the idea of Libra and a currency, the US government and no government, they didn't like that, because imagine the force they would have, more people than in India and China behind the power of Facebook. Oh my God, that would have been a little scary, a little interesting, and talks indirectly about some of the things that Balaji that I mentioned earlier, and the network state and digital. There's no question that within, 10, 20 years, something is coming. And we're seeing the elements of it now, where AI is going to maybe be running certain governments, making interesting decisions. And it may get a little weird with weaponry, biotech, and things like that. We're going to see rapid advancements. There will be winners and there will be losers. The scary part is the winners may be in extremely powerful position, and that may only last for 3 or 6 months. And I'm a little afraid they may end up taking advantage of that, knowing that they have that little edge. But going back to the bigger picture of the concept of network, the concept of a Meta and Facebook, and creating effectively, let's go with the word, their own currency. What was the vibe going through Silicon Valley when that was going down? Was it 3.5, 4 years ago? And a little bit of a vision for how that may play out in the future.
Yeah. So I think you're hitting on something really, really important. And I'll maybe back into that answer like this. I think that the biggest threat to a sovereign government is cryptocurrencies. Because if you don't control the money supply and the financial system, you have no leverage. You have no power over the populace.
In short, yes. Now,
so if you take that to your question about Meta and Libra, of course, there was no way in hell a centralized company, a centralized organization like Meta, or any centralized organization, is going to be allowed to have its own true currency that competes with the US dollar. It's an existential
you're getting some deep stuff now.
It's an existential threat to the government.
Effectively government control.
Not to the nation. It's
right.
A good thing for
it may be good for the nation.
Absolutely an existential threat to the government themselves. And so that's why, And that's why you see this battle going on over crypto and Bitcoin. And, you don't have to go farther than Bitcoin to see what's going on. But of course, there are way more sophisticated uses of blockchain and Web3 technology besides Bitcoin. But Bitcoin itself is an existential threat to sovereign nations.
Well,
Sovereign
did you ever
government.
go down a rabbit hole? Yes. And audience, I was talking about this 4 years ago. And to this day, again, the vast majority of you just, I don't know, Bitcoin goes up, I'll put a little bit of money into it, but I don't need to know the mechanics of it. Well, yeah, you kind of do. You used the word something like meta would be centralized. That means it's a single point of failure. What makes Bitcoin unique, we believe, is proof of work. Now, I don't want to go too deep down the rabbit hole here, but you know what I'm talking about. And those of you listen to my Michael Saylor and other interviews from a couple of years back, we'll do deeper dives into crypto in 2025. But the fact that there is we believe, no single point of failure. Now, we could argue the NSA, the US government back in the 90s may have a little bit of, okay, that's a little bit of conspiracy theory. Maybe there is truth to that. I'm not 100% sure it's not. But in theory, the concept of proof of work, miners, network effect, number of people, the fact that even if something were to go wrong, which really won't, but if it were to, there's backups and it could be recreated in like a Bitcoin, whatever, 2.0. So there are answers to some of the fears that some may have out there relative to that perspective. I could argue Bitcoin's protected by the Constitution. It employs multiple people here in the US. And other than Trump, I think most of the cabinet members that are on his team, and RFK was the most over the top, like most of his net worth is in Bitcoin. Imagine 4 years ago, a politician as part of a president's cabinet and multiple of them, probably Vivek and others, saying that. It would have been, I would have laughed at that. And it's amazing how things have changed. I think I have an important question, and this goes back to poker and goes back to effectively decision making. What's your process for making decisions when you have incomplete information, which is unlike chess, that is what you have in poker. And the reality is in life and investing, we almost, unless you're an insider, almost never have complete information. How do you not get frozen? How do you process information and make a decision?
Well, it's a very deep question. So I'll try to be as practical as I can. And I haven't really thought about that question yet, so forgive me if it's a little bit rambling. But the first thing that came up is it's about having a strategy. Okay, but a strategy is not the same as a formula. Everybody is looking for a formula. That's not possible when you have uncertainty. A strategy takes into account the fact that there's uncertainty and incomplete information, and in the cases of investing and poker, volatility, right? So the first thing when I think about strategy is to remember that there is a difference between a good strategic decision and an outcome. You might make a good decision and have a bad outcome. It's called getting unlucky. You might make a bad decision and have a good outcome. That's called getting lucky. And then the other two quadrants and the four quadrants, you make a good decision and have a good outcome. Well, that's the expected value. You make a bad decision, have a bad outcome. That's an expected value. So in order to have in order to deploy a good strategy, you need to be able to make individual strategic decisions based on that strategy. And then you also have to have enough of a long run for the volatility to wash itself out, and you can get to the expected value of that decision or that strategy. So in poker, for instance, there's often times where you're making a decision where you are, let's say, a 52% favorite in the hand. Okay. So roughly half the time, you're going to lose the hand. But roughly half the time, and with an edge, even if it's a small edge, you're going to win the hand. And so over time, if you can get to the statistical long run, you're going to be a really big winner. So when you're talking about games of incomplete information and volatility, it's really important to work with a strategy that has an edge, a built-in edge, and then give yourself enough time in terms of number of at-bats or, hands of poker or individual investments in venture investing or any type of investing for that matter, to get to the long run. And that's also known as the power of diversification as well. So that's base camp for the strategic decision-making space. I'm happy to go where you want from there.
Excellent. I probably got about 5 or 6 questions left, so it's going to be a lot of fun. Those of you that are live, feel free to ask a question. Some of you have commented, Amani, Mike, and others. And by the way, thank you. I didn't get any hate today. I'm getting a little bit of love. I did invite a new group of family offices that weren't as familiar with my work to join today in terms of a little bit of a live presentation. Hopefully you're probably scared away. Who is this crazy guy with the beard? And maybe a little bit on that note, then we'll get right back to it. And I know some of you think I go a little overboard with this, and you're probably right. But I'm obsessed in terms of what I do. I've been doing this for many decades. I've evolved and adapted and iterated like I think we all should, and grow and be a little bit more cutting edge, be a little bit out there, take a little bit more risk. Sometimes mitigate them, but also by mitigating risk, you may be limiting some of your upside. We didn't even talk about that when it comes to either investing in life or quote unquote in poker. And those are all decisions that many of us will have to make. But if you're enjoying a little bit of what you're hearing and would like to really be interactive, some of my proprietary content, my in-person gatherings, private calls and Zooms with me, and really be ingratiated in what I'm building in SFO continuity, my private club, simply go to Angelo Robles. I know it's boring, but that's my website. It's my name, angelorobles.com. You'll see it's a pretty simple site, but the opportunity to join and be a member. I know I've been talking about it for a while. Finally, we are just about there. What I call 30 founding or charter members, and then prices go up. I think it's 2 spots remaining. We're just about there. So I think it's wickedly underpriced relative to the value that you're going to get. If it's just one great idea that you end up thinking differently and acting on, then honestly, it's whatever, 10, 100x the value in terms of what you paid, let alone if you're going to be more active in it. So I would appreciate, now would be the perfect time before. And by the way, when things go up, it's still going to be a great bargain. You just didn't want to move quick. You're careful, which sometimes is good. But using a poker analogy, how bad could it be for the price I'm charging relative to the upside that you're going to get? The downside is effectively wickedly limited. I've been in the community for 20 years and I've outputted, I think, pretty impressive content that pushes boundaries. I'm not a newbie to this. But if you do enjoy some level of free content, my @FamilyOffice, I own that great brand on YouTube, @FamilyOffice TV. I'm active on LinkedIn and do like to share, usually more after the fact. Lately, these kind of interviews, I've been releasing parts of it or the full of it 2 to 4 weeks after the fact. But I make some exceptions because Rafe is a cool and exciting guest and wanted to make that available to everyone today. So in short, go to angelorobles.com and join at the best opportunity, literally right now, while you can. I have a couple of questions remaining. Again, my lighting is totally off today, so pardon me. You hinted at this one earlier. You've called crypto and blockchain the future of capital. Why are these technologies so transformative?
Yeah. Well, if we're just talking about the money portion, I just feel like, to me, it's very obvious. Money is a technology like anything else. It's a social technology. It allows us to do commerce and transact and store value. It's a technology. It's a tool. The blockchain way of doing money is just a superior technology. It's like we started, computer technology. It had vacuum tubes this big to hold a bit or a byte. Right now we have microchips. It's like you would never go back to running your computation on vacuum tubes. I just feel like, money has been revolutionized by a new technology. It's just a matter of time before all currency, whether it's, I mean, it doesn't need to be issued by a sovereign centralized authority. The reason why that came to be is because of the trust issue. But blockchain, as you know, and Bitcoin, it's meant to be a trustless architecture. There's no central authority. It's based on mathematics, the mathematics of cryptography. Sometimes people in the Bitcoin space say, in math, we trust. You don't have to trust a central authority or a middleman or government body, but that Bitcoin that you hold, it's never going to be hacked. It's never going to be going away. It's never going to be inflated. It's actually a deflationary currency in a sense, because 21 million Bitcoins ever in existence. And then people sometimes lose their keys. So it's going to, as a scarce resource, as a scarce hard money commodity resource, it's better than gold for backing a currency or for being a currency. It's the backing and it's the currency all in one. So there's so many different ways, and we could go on all day, but it's just a superior technology. I just think it's a foregone conclusion that cryptocurrencies, whether it's Bitcoin or a plethora of different currencies, will take over from sovereign currencies in the not distant future. So that's the money piece.
Very interesting comments. I may have some slight disagreements and challenges relative to quantum computing, relative to backdoor and Bitcoin, relative to really only 21 million, but we could save those discussions for a different time. I'm about 95% plus on board. When I look back to some of the biggest mistake I have made, and you may nod your head and agree, I should have purchased more. I didn't do enough. And then I got a little afraid in 2022 and made some decisions that, looking back, I wish I didn't make. Now, I don't know what the future is going to hold. I do know it's volatile. I do understand it's gone down 80% plus multiple times around something called halvings. But things, well, careful of this word, things are different now, but things are different now. Again, do I have the guts to put 50% plus of my net worth in there? No. Do I think Michael Saylor is crazy, brilliant, and amazing? But I did say crazy. Yes, it was incredible 2 or so, whatever it is, years ago to do an interview with him and challenge him on certain things. And that dude is a cool cucumber. And he ended up, now that he's worth about 9 billion, he ended up being 100% correct. I don't want to go down a rabbit hole of too much on broadly the Web3 and blockchain ecosystem, but things like stable coins, things like NFTs, and no, not the funky digital art, although who knows, that may end up coming back and having some value to younger people. But the underlying technology of blockchain and NFTs allowing for the fractionalization of real assets is going to get very, very interesting. And I don't know if you want to go lightly into that rabbit hole or a little bit deeper.
I'll just dig one scoop deeper. Okay. Yes, I agree with you 100% with what you just said. I think really, for me, what's really interesting is what's going to happen with decentralized autonomous organization, or DAOs.
Oh, DAOs, yes.
Okay. And just like I feel like Bitcoin or blockchain technology is taking over the function of money. Decentralized organizations on the blockchain, DAOs, are the future of corporate governance and the future of government governance. So if you think of something as important and foundational as stakeholder voting, whether you're talking about stakeholders of a company or you're talking about stakeholders, meaning voters in a democracy, it's a solved problem how to do a vote correctly and give people their representation that they deserve by right. It's a solved problem. Blockchain is meant to do that, and decentralized autonomous organizations are meant to do that. So there's going to be a bumpy road towards it, but I just don't see any future where DAOs are not the architecture of corporate governance as well as government body governance.
I completely agree. I used to also talk a lot about that and have one of the reasons why I'm in Wyoming with the great Senator Cynthia Lummis, what they're doing in crypto, and uniquely in the US. Again, they were the first, I think, in 1977 to have LLCs.
Yep.
What they're doing in DAOs is obviously no surprise, ahead of the curve. And the next 4 years with this administration might be the time to let's see what happens. Let's progress things further. And for the US to be anchored in the past while others may advance would not be to our benefit. This is, I hope, I could hope. I have some doubts here, but hope that it could be an interesting next couple of years. Going back to what I said earlier, again, we got a $36 trillion deficit. I don't see any easy way out. To do the right things would guarantee not being reelected in 4 years, but it'll be interesting to watch. That is for sure. What do you think venture capital VC will look like? We keep on going to this magical year because it's easy, 2030. So looking out ballpark about 5 years, I mentioned dynamics of AI touching every aspect of a family office. What will be the impact in the VC community?
Yeah, no, it's a great question, and I think about this a lot. What I see is I see there's a disruption going on in the industry known for disruption, which is venture capital, right? So the VCs are being disrupted by their own cooking, so to speak. So yes, AI, and yes, decentralized technology. I have a chapter in each of these in my book about exactly how I see that. But with respect to AI, it's utilizing AI to democratize access to the opportunities in terms of the portfolio companies, for doing due diligence, for automating tasks that humans are doing, for lowering the costs, lowering the barrier to entry. And so I think it's going to be very possible, and similar with blockchain technology. I see a time in the not too distant future where, any family office or high net individual angel investor can beat VCs at their own game. They can build a portfolio that's optimal with respect to game theory, in terms of diversification requirements. They can dial in their risk reward profile. They can dial in the thesis that they want. It's going to be kind of as simple as prompting an AI. I'd like a portfolio with 300, 500 startups in it. Here are the qualities of the founders that we need to have. Here's the various different sectors that I care about. Here are my family values, and have the AI execute it for low cost. And I think that capability is going to be in the hands of anybody, frankly, who has capital to invest. I feel like that that venture investing is something that is ready and needs to be democratized, because the risk-adjusted returns are through the roof. It's a great asset class, and there's no reason why it has to be limited to the high priests of Silicon Valley to be able to divine which startups are going to become the unicorns and give all the returns. I just see it's a real renaissance, and I love helping folks see the light and get red pilled on this. And the future is bright.
There you go. Being an optimist is a good thing. Samuel is making a note here from X. Angelo, are these recordings? This is great, like up on the YouTube platform. I kind of hinted at that earlier. Sometimes yes, and sometimes no. I do more and more that is not, that is non-listed, that is private, dedicated to my members. And sometimes after the fact, weeks later or longer, a truncated or edited versions may be more public. I'm doing this as a live, so I occasionally do that and make it more open. But I may actually take that down in about 2 days, do our producing and editing to it, share it exclusively with members, and maybe only put up some clips up on my platform. So we're kind of experimenting and feeling a little bit of that out. And again, if you want everything, like you got to join, you got to go to angelorobles.com and be a part of it. And that's really only fair for my members as well. Now, they also get the ability, I do like 30 different events throughout the year, usually intimate and small. Oh, and by the way, I do got two relatively larger programs. I'll be doing a 10X Investments Forum. I mean, I actually own that URL too, and that LLC. That's going to be April in New York City. We're going to have amazing people, some of them having guests on my program in public, crypto, and private markets. That's going to be really dynamic and exciting. Not just boring economists and macro strategists that usually suck at investing, but real investors, real people that often went from nothing to a hell of a lot. So that's going to be a lot of fun. And I will be doing a member program at the iconic Breakers, Palm Beach. Look forward to going back there. I'll actually briefly visit in 2 weeks. So I'll be in Palm Beach early, right before our Basel in December. And then I'm not going to give the date publicly yet, but in late March, I'm already booked and committed to the Breakers. So members, we got some fun and exciting and dynamic things coming up for you, which again is why you all got to jump in and be a part, because it's a really special community. Forget about me, just the incredible people like Rafe and others that I got to know, that I can make a direct connection to, that I could get you favorable access to the programs of meeting your peers, people that are, I got one member that did, and he's a New Yorker. He did a investment into a private company. Boy, talk about hitting a home run, Rafe. How about this one? Basically 300x a $1 million plus investment. I'm not going to mention the name of the company that's involved in data centers and AI now, but that boy hit it out of the park. I got another member that's invested. I did an interview with him. He's in his 80s. George Singular, that's invested in over 900 companies. I got incredible members. How could you not benefit from, forget about me if you don't like me or my content, just simply my activity and the people around it, I think are pretty incredible. As we begin to conclude, why don't you share maybe the 2 or 3 minute version? I do love the longer version, but the shorter version, the audience is going to be, Angelo, you got to ask about the World Series of Poker, how we got into it, lessons learned, a little bit of the final hand. Give us a little bit of a short story about how that played out.
Yeah. So this is in 2006, and I'd started playing World Series of Poker events in Las Vegas in the year 2001. And I hadn't had a lot of success. I'd cashed in some of the events, but I made my first televised final table actually the year before at a different series called the Ultimate Poker Challenge or something like that. And I ended up winning that one as well. That was a much smaller tournament. But then the next year, I entered a record-breaking pot limit hold'em tournament. I think there were over 1,100 people who entered. It was a 3-day tournament, and I ended up at the final table with some of my colleagues and idols like John Juanda, top-notch pro, and it was an incredibly wild ride final table. Of the last 4 people, I was one of the last 4 people, and I actually won the tournament. Each one of us had gotten really, really lucky at the final table to remain alive, meaning we were down to 1 or 2 cards that could help us survive. Otherwise, we'd be out. And so the volatility was through the roof. And so there was this iconic hand that if you look at the replay, of the tournament. I had the best hand in Hold'em, pocket aces, two aces, and my opponent CKY had a 7-2, known as like the worst hand in Hold'em. We got involved in a hand for all the marbles. I was a huge favorite before the flop, before the the cards came out in the middle. On the flop, he hit a third 7, and I was a huge underdog. The audience watching at home can see what's going on, but we have no idea. And it was just a very, very wild time. And I spiked an ace on the river to take down the pot, and then that catapulted into into the lead. So it was an incredible experience.
That is awesome. Look forward to having you back and discussing how things play out in 2025. Probably do a deeper dive into your incredible background and poker, get an update on progress of the book coming out and feedback. So probably in 6 months, man, we'll have a lot to talk about, but we're not quite done yet. One quick final question. Then I want to know what you're doing and how people could interact with you. Neuralink, and this may apply to poker, to investing. And yeah, getting my head drilled and having a chip put in is not something that I'm going to be doing today, tomorrow, next year, probably never, although never say never. But if it comes to the point when basically that kind of, I don't know how to quantify this, it makes you kind of have effectively like a 300 plus IQ. Like, how are the normies going to compete with that? Do you see, and again, this plays into the future, utopia, dystopia, where things could be headed, Elon, Neuralink. Does that scare you a little bit or get you a little bit excited?
Yeah. So in the near term, in the foreseeable future, I just don't see it being played out as a enhance your intelligence sort of thing that it's hyped to be at the moment. I don't think that's the way intelligence and cognition really work. You can't just like put a chip in and have it augment your intelligence. But what I do see is the current use case is, was it somebody who is blind being able to see? I think that was maybe the original experiment that they did. That I think is going to be transformative, for people who can't see, for instance. So there are parts of cognition. Vision is one part of cognition. There are parts of cognition that I think can be enhanced with something like Neuralink. But overall, I would say the bigger augmentation of our capacities and our competence is actually happening just by us interfacing the normal way, typing and talking with AI that is its own agent. And it doesn't have to be merged with us, but it is effectively leveling up our capacities. We're becoming 5x, 10x more productive, more creative, those of us who are actually leveraging AI right now in our lives. And we are outcompeting people who are not experimenting and using AI for their daily practices in business and life. And so what I would say is, if you're not already doing that, you should be experimenting with, ChatGPT or Google's, and see how can it improve your life and your ability to compete mentally right here and now, just using the normal interface of typing and talking.
I can't believe I'm going to ask this final question. So those of you on the left, you got to give me a little props for this, by the way. Yeah, I'm a libertarian. I skew a little bit right to that. I think Elon is incredible. We're so fortunate that he's here. He's doing amazing things. And I think the fact that he could be of value, in my opinion, maybe I'm proven wrong relative to the government perspective. But okay, we want a clip. And your answer, by the way, may simply be no, and that's fine. So here we go. Should we be a little bit afraid of Elon in any way relative to involvement in the government and where that could lead?
I think he is an X factor, no pun intended. I think that what we need right now is X factors, not just Elon, but I'm a huge fan of RFK Jr. And so we need that X factor. We need the volatility, to put it in financial or poker terms. We need the volatility right now. He has some good ideas, absolutely. And we know that good ideas are not enough. You need intentionality. You need a moral compass. I'm not sure he has the right moral compass to not be, a bit too maverick. But my hope is that it's not just about Elon and what Elon does. My hope is that we have a robust administration and a robust cabinet, so that we get the benefit of those positive black swans that he and others can bring to the table, but not the downside.
And in concluding, I'd like for you to talk a little bit again about the name of your book, when it's going to come out. We're going to have you back on in 6 months. That'll be a lot of fun. And I will say to my members out there, you just reach out to me. I'm happy to make an introduction to Rafe, and I'll mention member of my SFO continuity. He'll give you a very quick response and take extra care of you. So besides your book and how people could follow you on social and reach out to you, I mean, what do you do now besides investing your own money? And if I'm a investor or family office, do you consult on venture capital, on progress and change? How do you engage and work with investors and family offices?
Yeah, that's exactly what I'm doing. So for family offices, I advise and consult on how to do venture capital better than the VCs themselves, whether that's directly investing and building a portfolio, a money ball portfolio, or whether that's being a smart money LP. So people can reach out to me. My website, it's my name, rafefurst.com. That's the best way. And then on the other side of the fence, I coach and advise founders as well. So I just love the innovative early stage ecosystem, and I love democratizing access to both capital for the entrepreneurs and investment opportunities that are aligned with people's values and mission on the family office side. So.
And Rafe, doing you a little bit of a favor here, because first name and last name may be spelled differently than what some people think. It is R as in Robert, A as in Apple, F as in Frank, E as in Edward, pronounced Rafe, and last name, easy to pronounce first, but there's kind of one of two options. I don't want you to pick the wrong one. It is F-U, pardon the pun, R-S-T, again, F-U-R-S-T, Rafe Furst. And if you don't mind, give either that blog or website one more time.
Yep, it's Rafe Furst, FURST.com.
Easy enough, just like I'm AngeloRobles.com. We have slightly unique names. We probably registered 15, 20 years ago, and we're so fortunate.
Yep.
And again, the name of the upcoming book.
Yep, it's The Future of Venture Capital, how to win the VC game and make positive impact. And hey, for your members, so for people who sign up, if people sign up, based on this conversation, I'd be happy to send them a free book.
It's very kind. Thank you so much, by the way. My closing comments. Wow. I mean, a short interview for me, about 2 hours and 3 minutes, coming off a couple of Fridays ago with Ram Alawalia, 3 hours and 18 minutes. Nice. I really enjoyed this. I'm very curious. I learned so much. Rafe is an incredible man, and the opportunity, we may disagree on a couple of things, but that's what makes it engaging and so much fun. The opportunity of engaging and learning and being curious is really at the heart of where I'm at. Yeah, I'm a little quirky and different than most people in the family office world. I hope some of you, I don't need a lot of you to love me, maybe 30, 40, 50. Among 9 billion people, I think that's a pretty low ask. But we'll see. I don't know. My wife feels like, 30, maybe a little bit too much, Angelo. You're a little unusual. But I don't know. I hear the same old things, the same old mantras repeated by the same old people that I used to be a part of. Some of them even came after me because I've been in this community a long time. And going about different subjects on the future, on family offices, on VC, on investing in general, on public companies, on mitigating risk, on sovereign risk, on crypto, on AI. I don't know if I'm really, well, I am kind of an expert on best practices in the family office and being more productive, but I know a lot or enough, and I know the right people around so many different topics. It really is what I enjoy. I mentioned the verbiage earlier. Unfortunately, I'm not one of those 140 plus IQ. I wish I was. I don't quite have that gift, but I know how to be disciplined, how to be curious, well, disciplined sometimes, and I'm wickedly obsessed. And that actually has been a negative for me at some times in my life as I'm approaching a little bit of my older ages now, although I'm extremely obsessed about my health and wellness and exercise too. And I'll be putting in a 2-hour program tonight. It's the evening now, but got to be disciplined and no excuses. But I'm extremely obsessed about anything relative to investing, geopolitics, and how it circulates within the single family office community. This is the opportunity to join. Like I said, a preferred opportunity right at this very moment, kind of late November 2024. And it's okay if it's after the fact. You just won't quite be a founding charter member, and that's okay. It's better to be in the game than not be in it at all. So simply go to angelorobles.com. You'll easily be able to navigate it. My website is pretty simple and straightforward. And would love to, if you're an ultra high net worth investor family, want to create a single family office or already an existing one or an executive, honestly, it's the perfect fit. I know I could be a little bit over the top about it sometimes. That's a little bit of one of my faults, but I'm, again, obsessed and impassioned relative to what I do. And yeah, that may grate on people a little bit the wrong way. I love what I do. I dare anyone to challenge me that they're more obsessed about single family offices. What is wrong with my life? Like, of all the things I could have been obsessed about, why does it have to be the niche, the beyond the niche of single family offices? I mean, I like baseball, cigars, a good scotch. So I have other things, but in terms of obsession, really it's faith, my family, and my work within the single family office community. And maybe asking for more than 3 is probably a little too much. You can reach out to me, say hello, subscribe to all my platforms, LinkedIn, YouTube, etc. I hope to be more active on X and platforms like that as well. And that one, I do have the great moniker of @FamilyOffice, like I do on YouTube as well. So reach out to me, my direct email, which is up on my site. You could probably also put 2 and 2 together. It's Angelo at angelorobles.com. Again, Angelo at angelorobles.com. I hope all of you enjoy this upcoming week here in the US or flowing into next week, a wonderful Thanksgiving and holiday. I look forward to engaging with many of you in the future and have a strong end of the year. I got a lot to do and I'm really excited about it. Rafe, you've been an incredible guest. I really appreciate it and look forward
Angelo,
to meeting you.
Can I make a plug for you? Because I think you're selling yourself short.
Okay. Who am I to say no? Go for it.
Yeah. You are an expert in AI, in blockchain, and in venture capital. You really know your stuff. And I'm not saying that lightly. I talk to a lot of people. You're very, very knowledgeable and savvy about it. So anybody who is looking to, get family office advice from you, Angela's the real deal.
That's very kind of you, Rafe. I greatly appreciate it coming from you with your background as an entrepreneur, your decades in the Valley and the work that you do. I greatly appreciate it. And yes, those are things that I do love, but you said enough. Why don't we leave it at that? Great. I look forward to the next time. Look forward to keeping in touch. And audience, thank you all so much. Have a great day, everyone.